Hello, good afternoon, welcome. My name is April Schoen and I'm sitting here with John Curry.
Hello, April. Hello, everyone.
And we're excited to talk to you guys today about the role of whole life insurance and how it can be a powerful financial tool.
Easy for you to say.
Easy for me to say. That's right. And we're going to talk about today like how obviously the life insurance has a death benefit, so it's going to offer protection for your family or beneficiaries, charities. We're going to talk through that, of course. But we're also going to talk about how you can use it to build and safeguard wealth, which is something that not everybody knows that that's something that it can do for them.
I would say most people don't know. In fact, I would even argue that most people who are in the business of selling life insurance do not understand how to use the products properly.
Right. Yeah. You know, I think a lot of people just think about it as being something that's left behind for the family. And of course, there's a purpose and a role for that, which I know we're going to get into. But there's also benefits that you can use while you're alive, those living benefits, we like to call them.
And I can't wait to talk about that because being in business 50 years and being 72 years old, I have utilized my life insurance in ways I never, ever, April, would have thought possible.
Mm-hmm. Well, I think it'll be interesting today as we go through, because I'm 41, you're 72, we can talk about how we both use life insurance in different ways at these different stages of our life. I think that'd be great for people to hear about too. And listen, I know that life insurance isn't exactly a fun topic. Most people don't want to talk about it. You know, most people don't wake up and say, you know what sounds fun today? Like learning all about how life insurance works. But we're gonna make it fun along the way.
You know, the title of my book on life insurance was Life Insurance, the Essential Financial Tool That Everyone Loves to Hate.
That's right. That's right.
You know why that is? Because none of us really want to face up to our mortality. And if we talk about life insurance or think about it, we're thinking about our death. Same thing with getting a will done. So that's why people, they don't hate it. Once they understand it, they love it. As you know, they want more. But it's that stigma of, yeah, but I don't want to think about when you talk about dying. That's what it is.
Yeah. Yeah, we tend to procrastinate sometimes those like hard conversations to have or things that it's uncomfortable. So we don't want to talk about it. We don't want to think about it.
Yeah, it's not on my agenda to die today. I don't want to do it either.
Don't do that. That would really ruin my day, John.
Mine too.
Yeah. So here's what we're going to talk about today, guys. We're going to talk about if you want to know ways that you can like build and protect your wealth in predictable ways, if you're looking for tax efficient strategies to increase your retirement income, if you want security that's not tied to the ups and downs of the market, then you're in the right place because those are all the things that we're going to talk about today. So let's get into it.
I'll make another comment real quick.
Of course.
I promise everyone who's listening that if you stick with us, you're going to learn things about insurance that you've never heard anywhere else and probably never will, and ways that you can benefit. I promise you that.
So here's what we're going to talk about. Why you may want life insurance. You'll notice it doesn't say need. It's not necessarily why you may need it, but why you may want it. We're going to go through the different types of life insurance, key benefits of whole life insurance. We're going to talk a little bit about term insurance and when it makes sense. And then we're also going to talk about some case studies or some real life examples. So before we get into the specifics, let's just quickly cover the difference between two types of life insurance that's available and how they fit into financial planning, because they're really like two different types of products. You know, you can think of them as like apples and oranges, and they really do fit in for financial planning in different ways. So we're going to talk about the key differences between whole life insurance and term life insurance, and then we'll share with you too, like how we've used them in our own planning and for clients as well. So whole life insurance it's permanent coverage that doesn't have an expiration date. Sometimes you may hear someone say it's whole life insurance. It's designed to be in place for your whole life, right? So it's permanent coverage, so it the death benefit does not go away. Obviously, it has the death benefit that comes in tax-free to your family. And then it's also going to build cash value. So this cash value is going to grow tax deferred over time. So you're not paying any taxes while the cash is growing. And on that cash value growth, you can have guaranteed growth, and you can also have potential dividends. Now that's going to depend on the insurance company that the policy's with, but we're going to talk a little bit more about that later. But that is something that helps both the cash value and the death benefit grow. We're going to go into, but one of the things that we like also about the cash value is, that it can act as an asset on your balance sheet that's going to provide liquidity and stability in your financial plan, right? So we think of it more of like that, along with the savings components on our balance sheets, along with like retirement accounts, investments. It's not that one is better than the other, it's that they work well together in tandem. And then term life insurance is temporary coverage. So let's say you had a policy that was going to be enforced for 10 years, 20 years, 30 years. You're going to pay a premium for that amount of time. And if you pass away in that time frame, let's say you had a 20-year term policy, then that death benefit would come into the family tax-free. And at the end of the term, the life insurance goes away. This is more of a protection-only vehicle. It's not really what we think about more for like long-term planning. It is going to have initially a lower cost. So this is really designed to have high coverage, high death benefit amounts with an affordable price. And it's good for like younger families that are looking to protect their income against, I love it when it says premature death. Because I know we joke, whenever I die, I'll be premature, right?
That's right.
But we really think about like younger families. Like I'll give myself an example. I'm married. I have two boys that are 8 and 11. So I have a lot of financial responsibility. If something happened to me tomorrow, not only would my family have an emotional loss, but they'd have a financial one as well. And I've taken care of that risk. I've taken that risk off the table with the life insurance that I have. So I have term life insurance to come in to help replace my income for the family.
And you've locked in your future insurability by doing that. I have a quick question for you and everyone who's listening. Would you rather own a house or rent a house?
Own.
Tell me why.
I'm going to build equity.
That's what whole life does. See, whole life is like owning the house. The term insurance is like renting the house. Mm-hmm. And there's a whole lot of benefits of ownership that none of us would ever dispute. And that's the difference between the two types of coverages. If you break it down to the most simple explanation. Mm-hmm. You own it, you have control of it, you got equity, tax-deferred growth on it, just like home equity. Term, you have coverage, but then once it's up, you lose it. And I would argue that it's not the lowest cost either. It might be it might have a lower premium, but if we truly measured economically like you and I've been trained to do, and we educate our clients, it's usually more expensive to have term and do something else than to have the whole life.
Right. That's true. Mm-hmm. Yeah, so I have both. I have term insurance and I have whole life. So I have the term to have a larger death benefit today for the family. Like I said, if something happened to me tomorrow, because it's important to me that financially for them, life is the same, right? If something happened to me, I want my husband, like you mentioned the house, right? I want him to be able to stay in the house. I don't want him to have to sell the house because they can't afford it now. Right. And we've seen that happen with people. I want vacations to be the same and college funds to be the same. I want future weddings paid for. There's all these things that I want to still happen for my boys.
Think about the way you're saying that. What you want is the path you're on. You don't want your family to have to abandon that because of lack of financial resources. Mm-hmm. So you're insuring those financial resources, mm-hmm. which is you.
Yeah.
The most important financial asset you have is yourself, mm-hmm. because of the economic value you create by working.
Mm-hmm. Absolutely. Yeah, so make sure that those things are still going to be there. No, I'm not planning on dying tomorrow.
Good.
And so that's why I also have the whole life insurance that I do. That's part of my wealth building strategy. So I know as we're getting into that today, I'm going to share some more about my viewpoints on that too. So before we get into more about these different types of insurance, I just want to pose a question. If we were, let's say we had a blank sheet of paper and we're designing like the perfect financial tool, one that's going to provide you security, flexibility, long-term success, what would some of those characteristics be? What would you want this tool to do, and or maybe to even not do? And I'm going to give you kind of a list here of some things that we put together when we start thinking about what would be like an ideal financial strategy. Well, one, we'd want to minimize risk and loss of money, right? We don't want to put our hard-earned money savings at unnecessary risk. So we'd want a financial tool that's going to offer stability, that's going to offer protection. We want to minimize taxes, both while it's growing and when we go to take it out in the future. Right? Taxes is something that can eat away at our wealth over time. So we want a tool that's going to allow for some more tax efficient growth and also tax advantage distributions. I want to have my cake and eat it too, on both sides of that.
Absolutely.
We want to earn a competitive rate of return. We don't want it just to sit stagnant. We want our money to grow at a reasonable rate. We want it to outpace inflation. We want to have long-term financial success. We want to be able to have access to our money throughout our life. Flexibility is key. We should be able to access the funds when we need them, whether that's in our working years, retirement, or some sort of like unexpected expenses that may come up. We want to be able to prepare for contingencies like death, disability, emergencies, unforeseen factors, right? Because we all know life happens. The ideal financial tool should be able to provide some built-in safety net for all of those things. And so what if we told you then that this financial tool does exist today? There is something that can do all of that, and this is where that life insurance fits in, that the whole life insurance can check off those boxes, and that's what we're going to talk about next. So let's get into some of the key benefits here when we think about the whole life insurance and how that fits into your overall strategy and why it's going to kind of check off some of those boxes that we talked about. So first, it's going to have this income tax-free death benefit to your beneficiaries. So if you pass away or when you pass away, that death benefit is going to come in tax-free. It could be to the family. It could be to an organization, a charity that you care about, but it's going to come in income tax-free, which is unlike other assets that could be subject to estate taxes, income taxes. You think about if you're leaving like retirement accounts behind. We were just talking with a client yesterday about wanting to leave some property to their daughter and what's the best way from a tax perspective to do that. So it's going to allow you to have more, effective, easy legacy creation. Can include that guaranteed growth on the cash value and potential dividends. So whole life insurance offers guaranteed cash value growth, meaning that your policy's value is going to increase every year, regardless of market conditions. We like to say it never has a bad day, like in the market does. And not only does it have guaranteed growth, but many policies also pay dividends, which can be used to increase cash value, buy additional coverage, and can even be used to take as cash. We were just talking with a client who's retired and has her life insurance policy, and we were just talking about the options for her to use the dividends to supplement her income.
Take them in cash and spend it if you want to.
That's right. So dividends are not guaranteed. Many financially strong insurance companies have a long history, though, of consistently paying them. So that when we get to talking about, when we start thinking about the insurance company and who you should be using, that's one of the things that you want to look at. What is their dividend history? The cash is going to grow tax deferred. So unlike other like taxable investment accounts, the cash value grows tax deferred. So you're not paying taxes on the gains every year. That means you get to keep more money in your pocket. This means your money is allowed to compound faster, which can help have longer term growth. And it's going to give you more flexibility in retirement because you can access those funds on a more tax advantage basis. The cash value is also liquid and available to you at any time. So unlike retirement accounts where you might have to wait till you're 59 and a half, or you have to wait, let's say even have like an account for 5 years or more, some stipulations, you can have access to this along the way. So what are some things that you can use the cash value for? You can use it to cover unexpected expenses, pay college tuition, start a business, supplement retirement income. There's lots of flexibility.
Buy a house.
Buy a house.
I literally bought a house on the Florida River by using the cash values. Instead of using the bank money, I used the cash value loan, bought the property, and then I went and got a permanent financing letter. I was able to close on it. There were 4 couples wanting to buy it, and I told the seller, I said, I can have the money in 24 hours. He said, no way. I said, yep. He said, how do I know that? I said, hang on. So called the insurance company, got the lady on the phone, see if we could overnight a check. He says, okay, it's yours. So I went straight to the head of the back.
Okay.
Same thing with the house right down the road that I bought in May of '94. I was going to use money in my mutual funds for the down payment and closing costs. The market was down bad in May of '94.
Mm-hmm.
So instead of doing that, I borrowed on my life insurance policy. I used that money to get into the house. When the market came back up, I cashed in the mutual fund when it grew again, paid off my loan.
Mm-hmm.
I could give you a dozen examples of how to use it. Cars, business equipment, health insurance costs, not health insurance costs, but health costs when my mother got sick.
Mm-hmm.
I could give you easily a dozen, probably 20, that I've used personally.
Lots of flexibility. That's what I think. That's what a lot of people kind of don't realize, the flexibility.
I feel so strong about that. The only other asset that I might consider more important might be my house.
Mm-hmm.
And I'm not even sure about that. House could blow away because of the cash values. I can go get a new house. If my cash values blew away, I'd be in trouble.
That's right. Well, speaking of some protection there too, this is going to depend on your state, but you can have asset protection where the cash value is shielded from lawsuits and creditors. But again, this is going to depend on state law, so you really want to pay attention to that. We're in Florida, so here in Florida, cash value is fully protected from lawsuits and creditors. You can have flexibility to adjust premiums. So you again, we talked about the dividends, so you could use the dividends to reduce premiums, cover them for a period of time. You can modify the payment schedules as well. So it can be more flexible and fit into that long-term plan. You're not stuck with it a certain way. And it's also a non-correlated asset. So what does that mean? That means the cash value growth is not tied to the stock market. It gives you that more stability. So where we're going to see our investments or retirement accounts rise and fall with the market, this is going to provide more like that steady growth no matter what's happening in the economy. So you can use this for more than just protection. It's a very versatile financial tool. And so next we're going to get into how this can go into financial planning and then talk about some other key benefits as well. So how can it help you in retirement? Because sometimes people say, well, I'm going to retire so I don't need my life insurance anymore. And the key word there is need. You may not need it, but you may want what it can do for you. So let's talk about where this fits in with overall retirement planning. John and I work with a lot of clients who are getting ready to retire and are into retirement. And so I can tell you from us sitting with hundreds and hundreds of clients that one of the biggest concerns that they face is how much can they take from their money, their investments, their retirement accounts without running out of money. And this is true for someone who's getting close to retirement and also into it, right? So we see this all the time, about how much can I take out, or maybe I need something, but I don't want to spend it because it's my just in case money.
Yep.
Just in case I need it, just in case this happens, just in case that happens.
And they don't use it. So they end up leaving it behind, and someone else does all the things that they never got around doing. I want to make a quick comment about something. You talked about may not need the life insurance in retirement. People are guilty of canceling policies when they retire. I don't need it. But yet you can't turn the television on now without seeing an ad for somebody wanting to buy existing life insurance policies. Mm-hmm. So think that through for a minute. You got a third-party company who's willing to buy your life insurance policy or buy mine. They'd rather have mine.
Right.
Because of my age and health.
Right.
So why would they want to do that? Because ultimately there's going to be what's called the inevitable gain of a life insurance policy. Someday you're going to die. That money will come in tax-free to someone. Mm-hmm. Okay. If I even bought it as an investment, maybe I pay tax on it, but it's still money I get that's guaranteed.
Mm-hmm.
So people are being told you don't need the insurance anymore. It's actually a sales pitch. You don't need this. You're now retired. Let us buy your policy.
Mm-hmm.
And they'll give you money for the policy. Now, when you die, they get the death benefit, and all the cash value buildup that's inside that policy is now theirs. So think that through. If a third party is willing to buy your policy, why in the hell would you give it up? There's no way you get in my policy. Period.
Yeah, it's more economically beneficial for them.
Absolutely.
Mm-hmm. Than it is for you. Absolutely. So let's talk about this with this retirement planning. A lot of people will underspend in their retirement. They don't spend kind of what they could because it's out of fear that how long am I going to live? Am I going to run out of my money? Is my spouse going to run out of money? So that's where we kind of see they can underspend. So this is where some of the insurance can help, because if it's structured properly, this can actually give you a permission slip to spend other assets. So you might hesitate to say, oh, I don't want to take too much out of my retirement accounts or my investments because I don't know how long I'm going to need them. But this is going to allow you to have more certainty, because the life insurance is going to provide that guaranteed death benefit. So this is going to be more like a safety net. It's going to allow you to spend down your other assets because the death benefit is going to come in tax-free. So let me give you an example. Let's say there's a couple, husband and wife, they're stepping into retirement, and let's say the husband has most of his retirement savings in a 401k, right? And again, he might worry about, not wanting to take too much out because how am I going to need it for?
Right.
Is it 20 years, 30 years, 40 years? How long is this bucket of money going to have to last me? So instead of just taking out what they truly need, they might take out less. They might take out the bare minimum, which is going to just limit how much they can enjoy in retirement. So now think about the opposite though. And let's just use we'll use some numbers too. But let's say that they had an equal amount in life insurance death benefit that he has in his 401k. How does that change his planning? What does that now allow him to do?
He can spend every dollar. They can spend every dollar. And then we get into the best ways of using the money, because if it's done properly, they increase their income and still not run out of money. But I'm in that mode now. At 72, I'm drawing down on assets that I want to use for things, and knowing that upon my death, all of my inheritance wishes are taken care of with life insurance. Everything else goes into the trust. So retirement accounts, investment accounts, real estate holdings, all of that is free and clear. They can go into the trust to provide additional benefits to the people that I love and care about. But I have the ability to take care of me first without hurting them. So it sounds kind of strange. If I didn't have the life insurance, somebody's going to get shortchanged, right? Either I will because I didn't enjoy the money, or they will because I did enjoy the money to improve my quality of life and I spent it all.
Yeah, if you don't have insurance, your assets become your insurance.
Absolutely. And assets are not good insurance, and insurance is not good assets as far as the death benefit goes. Once you, in order for it to become an asset, the death benefit itself, you got to be dead.
Yeah.
But you can benefit from it without actually dying is the key point.
Yeah, so in this example for this couple, if he knows he's got the life insurance that's going to come in tax-free to fill that bucket back up, then he can spend every dollar. And then I agree with you, there's definitely some planning and strategies they can use to where they make sure they don't run out of money in that 401k. But even if they did, let's just say worst case scenario happened, and they still have their cash value.
Correct.
That they could rely on if they needed to.
Let me amplify that, because I'm in a position now where I took a chunk of my retirement lump sum money and created a stream of income that will last me the rest of my life. And I have more income. I don't have to worry about it. On the first day of each month, that check is direct deposit to my checking account. In addition, the life insurance is more than enough to replace that income upon my death. The cash values of the various policies I own, I can tap into if I want more money for anything. If I want to take a vacation, if I want more income, I don't need it, it's still working. But the peace of mind is just unbelievable knowing that I have that if I need it or want it.
Gives you that flexibility and that control, right? So it allows you then to confidently spend other assets knowing that you have this death benefit that's going to pass to the family tax-free. So again, it's giving more of that confidence and really letting you then have more control over what you do and don't do in retirement. So not all life insurance companies are the same. So when you're thinking about, a policy, you really want to take a look at the company and make sure that you're using a company that has a strong financial foundation and it's going to have some favorable features and benefits as well. So here's a couple things you want to look for. You want to look for strong financial ratings and also a company that's been around for a long time. So it has a long-standing history. We would say look for a company that's got 100+ years of history. This is going to show you like stability, reliability. Think about all those economic things that they would have gone through in the last 100+ years. That's also going to help make sure that company can deliver on guarantees and pay dividends. You want to look at dividend performance and history to understand how that's been changed over time. So you want to look for a good, strong dividend history and also look for fixed loan terms instead of variable loans rates. That's something we were just walking through with a client the other day. And then looking at also the different options they have for you that you have availability of some policies that can build cash earlier in the policy, early cash value growth, also allowing for conversion. A term insurance policy like we were talking about earlier, this can allow you to seamlessly convert that to a whole life policy with no medical underwriting. That's what John meant about, for me, having the terms that I've locked in my insurability. So yes, I have the protection now, but what I'm doing is I'm strategically converting part of the term to whole life. And so doing that, so I don't have to worry about the medical underwriting again.
That's what I've done over the years. I have no term insurance now. Over the years, we've actually got it all upgraded. We call it converting in the business, but it's upgrading it to permanent, good quality whole life insurance. And also, I think we need to talk about the different types of companies. You have mutual companies, you have stock companies. And the best way to describe that, think about a bank. A bank would be like a stock company. Okay, what's the bank's role? Board of directors is what? They got to make as much profit for the shareholders as possible. Versus a credit union who works for the benefit of their members. So a mutual life insurance company is the preferred company if you can get your coverage there. Because you're going to participate in the surplus, meaning if there's a surplus at the end of the year, that's what determines that dividend. And I started off with a stock company 50 years ago. And I wish I had been with the company we're with now, with Guardian, all the time because of their performance, but it wasn't. And there's a big difference. And I would say that most people have never had that explained to them in a way that they can see what that policy might look like performance-wise 10, 20, 30, 40, 50 years down the road.
Yeah, I also worked for a stock company at first. Yep. And saw firsthand, decisions that were made, like you said, to benefit more the board of directors or the stock shareholders, not necessarily the policy holders.
Absolutely, and I'm not picking on the stock companies because, frankly, I own some stock in some of those companies via the ETFs and the mutual funds. And if you have mutual funds, you do too out there. But if I'm going to want to protect my family, it give me the best bang for the buck, then I won't mind with a good quality mutual company.
Right.
And I did that many years ago.
Absolutely. So let's get into some examples. I think talk about some real life examples where we've seen this come into play.
Before you go there, would you go back to that previous slide when you're talking about the cash value and designing the policies? Let's talk about that for a moment. I think it's very important that everyone listening that whether it be us or someone else, they find someone that doesn't just dabble at the insurance side. They're an insurance specialist. When I started 50 years ago, that's all I did was life insurance, term insurance, whole life insurance. That was it.
Mm-hmm.
And then later, I wanted to do more of the financial planning. So 2 years later, 1977, 77, I proceeded to become licensed to be able to do any type of investment account. But too many people don't do life insurance full time. It's kind of like they're dabble. They're like called a broker. And find someone, whether it's us or someone like us, they can sit down with you and help you design the plan. Because there are different policies. It's like a toolbox. We got all these policies, like different tools in that box that we can use. I own 7 different policies, different types, all whole life category, but they're a different type of whole life for various reasons. Right? But I just thought about needing to share that.
Yeah, absolutely. Okay, so real life examples. So let's get into a few things here. One is obviously creating a legacy through the death benefit. So we'll talk about some options here, but this is really going to ensure, again, that your loved ones are protected, that they receive that tax-free inheritance when you pass away. So what can that be used for? Used to income for a spouse. It can be used to cover taxes, expenses. It can be used to leave a financial gift for children, charities, like organizations that you care about. And, unlike market investments that are more market-based, this is going to have that guaranteed death benefit that's going to have more of that financial security that you can think of, again, spouse, future generations. You can use that cash value as liquidity. And so you can use it at any time for any reason. We gave some examples earlier, but we've had clients use it to buy a car, buy a house, an investment property, pay for medical expenses, pay to renovate the home, pay for kids' college, right? There's a lot of options, float payroll. So there's a lot of different options out there on why you can use the cash value if you need to along the way. And then you can also use it to supplement retirement income. So again, this is that cash value piece of the client I was just talking about who used his life insurance to replace the income she was losing. Well, she has her life insurance policy as well. Now, she's doing great and fine, wonderfully financially. She's not going to need to tap into that. That will most likely just, the death benefit will go to the family when she's passed away. But she does have it just in case. It's going to be kind of that backstop for her, where if she does need more income, let's say she needed it for care, that's an option too, that she could use the cash value of her own policy.
I have a thought that I want to share. I own policies on several family members. So if you're sitting there thinking, well, maybe I'm to the point of where I'm uninsurable, I can't get life insurance, or I think the cost will be too high, the benefits of life insurance would help a lot of people. So in my situation, I own the policies, therefore the cash value is under my control. I reserve the right to use that for me first if I need to. But along the way, I've allowed different people in the family to use some of the cash to go buy a car, whatever, by doing a policy loan or as collateral for a loan, to make sure they pay it back. Okay. But as long as I'm living, I own the policy. I die, my trust owns the policy. Okay. And the structure where they have this benefit in place to take care of their families later in life. And by making those premium payments, I'm saving money that I can use for them. I just paid 2 premiums last week on 2 policies. I didn't have to. You mentioned the dividends earlier. I could have used the dividends and had planned to offset the premiums, to pay it for me. And it would have paid it in full on 2 people. But instead, I made the premium payment. On one of them, it was $8,009. The cash value increase when I made that payment of $8,009. Guess what the increase was for this year?
What was it?
$15,000.
Wow.
Almost double.
Yeah.
Because it's been enforced for a long time. So when I look at what I'm earning on savings accounts, I said, that's crazy. I took the money out of my savings account, paid the premium.
Yeah.
And I can look at it each year and make that choice. But don't rule out insuring other people that you care about, because you, especially with children and grandchildren, imagine this, long after I'm dead and gone, they have insurance in place that will help them. For everything you've covered here today, it would help them later because of me doing it today.
Yeah, that's why I have insurance on the boys.
And it protects their insurability. My son was in a terrible car accident in June of 2012. Insurable for a long time, probably still is. But fortunately, I had term insurance on him a lot, as much as the company would let me get. I also had insurability options on him. So every time one comes up, there's two more. And when they come up, I will exercise. That way I get him covered. Because he couldn't get the same coverage. He could get the same coverage today, but it wouldn't be at the same premium. Let's put it that way. It'd be much higher.
Yeah, so I think we've covered a lot here, thinking about, yes, there is the protection from the death benefit, but it also is that powerful financial tool that's going to provide more of that security, liquidity, financial control.
I just thought of something else. I have two charities that I support. And so one of my life insurance policies, those two charities are the beneficiary. So money that I'm giving them while here today, when I die, they would lose that, wouldn't they? If I'm not here, they get no gifts.
Right.
So the life insurance, by going to the foundations for these two organizations, will help continue the things that I've been doing while living.
Yeah, it's very powerful.
It's very powerful. Long after I'm dead and gone, they're still getting the benefit of that. They'll take the proceeds, they'll invest it to help with the foundation's needs.
That's awesome. So today, we've covered a lot of these strategies, thinking about like how to build, protect, grow wealth. And so the question that is going to be is like, is this strategy right for you? And it's really important that you don't try to implement these strategies on your own without some professional guidance, because the last thing you want to do is like make a mistake that's going to cost you like taxes, lost opportunities, right? Financial security. So make sure you don't make a mistake. So make sure you're working with someone on these strategies. And if you're curious about them, then I encourage us to schedule a time for a consultation. So at this call, at this session, what we would do is we're going to help you get clarity on your financial goals and concerns. We're going to help you identify opportunities, right? Is it one of the strategies we talked about here? Is one of those would be a good fit for you? We're going to talk about, are there any like roadblocks in your way? And then also map out some next steps that's going to help save you time, money, and effort, getting you closer to those goals that you have. And I don't know if we're the right fit for you, because we're not the right fit for everyone. But I can tell you that after having this session, we can determine if it makes sense for us to continue working together. So again, this call is complimentary. There's no charge for it. And so this call would really be for you if you're motivated, you're committed to reaching your goals, you're coachable, open-minded, you're willing to listen to some new ideas, and that you're an action taker. But this call's not for you if you're not coachable, you're not open to any professional guidance, and if you're just really expecting a lot of free consulting along the way. So the best way to schedule a call is you can go to our website, which is curryschoenfinancial.com, and there's going to be a button that says book a call. It's very easy. It's going to take you a link to my calendar. You can select a 30-minute call, and you'll see the times that are available. You can also call our office. So you could call 850-562-3000. Again, the number is 850-562-3000. And you can tell Luke or Leslie that you were on the webinar, that you heard our podcast or our YouTube video, and that you'd like to schedule a time for your complimentary consultation. I hope you guys enjoyed today. We look forward to helping you take the next best step to having a more confident and secure financial future. And we look forward to talking to you next time.
This was fun. I enjoyed doing this. Have a good day, folks.
Bye now.